Hey Denzel, how can I use savings or my retirement accounts or different assets to apply the infinite banking method to start a policy? Is there a way I can do that? Sure. Let's say, for example, I have a 401k. It's got a couple 100,000 in it. And let's say I've got about maybe 50k in savings or less, or 10k, whatever the number is, right? Let's say I've got savings and retirement, and we're looking to become debt free. We want to pay off all our debt, and we want to establish that life insurance policy. We want to create our own tax free bank. If that's your goal, one of the first moves that I would make is to first get the line of credit. I want to have a good credit card, number one, and I want to have a good line of credit, personal, business, or a HELOC, one of the three. Once I get those two pieces in play, I then want to have an accountability partner in my corner. The fourth thing that I want to do is find me an agent, a life insurance agent that I know, like, and trust. I got to do my research, got to do my homework around this concept. I want to make sure I don't get duped into the wrong product. Okay, that's my goal. I don't want to get messed up. I don't want to design something that I'm going to have regrets later on. Okay, and I don't do that with my clients. I make sure before we put a policy in place, before we apply velocity banking, you are confident. You are confident. You have conviction that this will work. And here would be the strategy. If you're 59 and a half or younger, I want you to look into what's called a 72T distribution and see if we can pull money out of that retirement account without getting the tax penalty. Okay, with the 72T distribution, we can avoid that 10% tax penalty and get early distributions, income, to use to fund that policy that we want. That's the first step. With your savings, we want to strategically figure out how much money were you saving in a year, and then we take 40% of that number and we can apply it to our policy. Okay, that's something that I've been doing recently with a lot of my clients, is doing like a 60-40 method, where we take 40% of our savings or 40% of our cash flow or 40% of our assets and stuff it into the policy. The other 60% gets invested in cash flowing properties, creating multiple flows of income, 10xing our income, investing in ourselves, in our business, the other 60%. That line of credit that I talked about earlier, let's say we get that in place. I want to strategically make chunks that match what my expenses are in a year. So if I can get in anywhere from 2 to 3 chunks into my policy using the bank's money first, to fund my policy along with my savings, along with some retirement, right? Simultaneously minimizing my premium costs. There's a strategic way to do that. Minimizing our premium costs, maximizing our ability to fund the policy, which is our MECO, okay? MEC, Modified Endowment Contract. We want to maximize that number, minimize the premium costs, so we have all of our dollars working for us, all of our cash working for us, tax-free. Now, what's going to happen is you just created a debt on this line of credit, and we want to pay off debt, and we also want to create wealth. Doing that, becoming our own banker. If we're going to pay off debt from the policy, not the line of credit, we're using the line of credit to chunk into the policy. We're using the policy to borrow against it, to make a chunk towards the debt to increase cash flow, to also take out additional monies which would represent your monthly expenses. Okay, so we're taking out a chunk and we're taking out expenses for that specific month, lands into our checking account. The checking account makes the chunk, pays off the specific debt, and then the rest goes towards paying bills. Meanwhile, that monthly income that comes in, that income is going to drive into your line of credit. We've got the line of credit here, we've got the policy here, we got our checking account right here. Here's what's happening to the money. It's going like this, and back down. Nice little triangle. Okay? Financial flow. Okay, we create that method right there, We're using the policy to chunk out of debt and the policy to pay expenses on a monthly basis. Meanwhile, all our income is driving into the line of credit, paying that off extremely fast. Why? Because we're not pulling money back out of the line of credit, right? It's going to sit there and we're going to wait. Let's say we're able to drop that line of credit, pay it off within 4 months or less, right? Let's say we take out 20K at a line of credit, fund the policy, we make 5K a month. 5, 5, 5, 5, boom, 4 months, done. What do? Month 4, month 5, make that second chunk into the policy. That second chunk is going to pay back your policy loans, that chunking that you took out, and the expenses that you had, whether it was like $3,000 a month expenses or 4, whatever the case may be. To really recap, bring it all in, we need to have that line of credit in place. And then we need to have that agent that we know, like, and trust. Create the system, velocity banking and infinite banking together. We get all those in place, we'll be able to minimize our losses, maximize our gains, minimize our cost of moving money, creating a financial flow. My name is Denzel. I hope this was very helpful for you. Have yourself a wonderful day. God bless.